the Magnificent Seven blinked, if you will. There was a chink in the armor. There was, the way the market moved, it changed a little.
This is the problem with portfolio managers. Too many of us think we've got great intuition, we've got great minds, we've got brains that can, and you know what? We blow it all the time when we pick stocks. But running a system that has a screen on it, I think, is the way around that.
So those returns are actually coming from smaller cap stocks, and that's a good thing. And that's part of the rotation we predicted. And
for our fundamental strategy, we're going to see this groundswell of fundamental companies, companies that make real things, that produce real services, are going to start performing better.
Hi, Tower Talk listeners. As you can see, we've got a great episode planned for you, and we'll get back to it in just a minute. Now, if you're not currently a Tower client, but you have questions about your investment portfolio, or maybe feel like you're not receiving the best service at your current firm, please reach out for an information-only, no-pressure discussion. We would love to hear from you. The email address is in the episode description. Now, if you are a Tower client and you have questions, we'd love to hear from you as well. I think you know how to get a hold of me, but if not, that email address in the episode description will work as well. All right, let's get to today's show.
Welcome here. We're delighted to have a little bit of your time in July 2024. Thank you for making time to listen to this. We have only a couple of things that we want to talk about. One is this rotation in the market. We have been anticipating that possibly there will be a rotation from this concentration of these few stocks, the tech stocks, over to the broader market. It looked like it might have started last week, and Tarek's going to talk about that. Then the second item that we're going to talk about is a new dividend portfolio that we're putting together. Just wanted you to know in case that would be of interest to you. Number one, what's happening in the market? Tarek.
Awesome. Thanks, Mark. So I'm certain that all of our current listeners listened to the last episode, but if not, I'm loath to, but going to give you a little bit of homework. Go ahead, listen to the previous episode where we talked about the concentration in the U.S. market in particular. It's the Magnificent Six or the Magnificent Seven. If you've listened to any sort of financial press, you've heard about these companies. These big companies we've all heard of: Amazon, Apple, Google, Nvidia, Meta, and Microsoft, that have just been carrying the U.S. stock market and, in fact, the world market. They are responsible for the vast majority of the returns in the S&P 500 in the last year. And what we have been saying is this concentration is too high. Those six names represented over 33% of them, or over 32% of the market. And we think a rotation is coming. The valuations are outrageous. These are big established companies. We understand that, but the valuations are still very, very high. We talked about the high price to earnings.
What does that mean? What does that mean? Outrageous? PE of?
Yeah, we talked about Nvidia's PE at the time of our last episode. It was 76 times earnings, maybe almost 77 times earnings. So that's 76 years of earnings in the current price. Not to say Nvidia is not making a lot of money, but that's just very, very high. Now, it seems as though in the first 2 weeks of July, we're recording this, there was the Magnificent Seven blinked, if you will. There was a chink in the armor. There was, the way the market moved, it changed a little. So there's a couple reasons for that, and I'll get into. But to demonstrate that, the S&P 500 from the end of June to July 12th, that's when roughly we're recording this, the S&P 500 was up 2.9%. Now, usually, or historically, for the concentration we've seen, most of that return has come from the Magnificent Six that I listed previously. But Amazon didn't hit that number. Google didn't hit that number. Meta was negative over that time period. Microsoft didn't hit that number. So those returns are actually coming from smaller cap stocks, and that's a good thing. And that's part of the rotation we predicted. And, I think we do a good job, if you're a regular listener, of saying when we miss a call, when we call a recession, it doesn't happen. We're happy to say, hey, we missed that one. But we're also going to take credit for this one, because we definitely said this market rotation is coming. And we're starting to see signs of it right now.
What this does for us is it helps serve the strategy that we have. We do not have a strategy that will rotate into these sort of hot areas of the market. We do have a momentum strategy, but we limit our exposure in those to only 25%. We will not have, there are 12 stocks in that momentum portfolio, and we'll only have 3 stocks in an area. Well, to really be in the S&P over the last 18 months, you needed to have 6 names in there, and they would have been screened in, but we wouldn't have that type of concentration. Our limit would be 3. what's going to happen next is our strategy of not being overly concentrated will allow us to participate in the next ones that are starting to move. So we think this is good both for the momentum strategy that we have, and number two, for our fundamental strategy, we're going to see this groundswell of fundamental companies that make real things, that produce real services, are going to start performing better. Where do we go on multiples on those magnificent 6-7 stocks? If they're 70, what should the multiple be?
Good
Well,
question. Now, multiples are usually higher for tech stocks. I hate to be an aggressive bear, to be doom and gloom, but I think it's reasonable to assume a sizable cut. Once
right,
rates start to come down in the U.S., and I think that's part of the reason why we're seeing this. All of a
right,
sudden, a number of other companies become very, very attractive, and
right.
capital gets deployed there, right?
So
And
if the
so,
market multiple should be between 18 and 22, and these are at 70, should it come back to 30? Yeah, probably.
yeah, maybe.
Earnings will grow a little bit and the stock price will come back. Anyway, enough on that. We're launching this new strategy. I think it's a really interesting strategy.
Mhm.
In fact, we will seed it. Elaine and I will put some of our money into it to be the first account to go into it. It's the dividend yield portfolio. I'm really quite excited about it. Jack's going to talk a little bit about what makes it. The key that I want to say is it is a mathematical screening system again. This is the problem with portfolio managers. Too many of us think we've got great intuition, we've got great minds, we've got brains that can, and you know what? We blow it all the time when we pick stocks. But running a system that has a screen on it, I think, is the way around that. Take it away, Terry.
Absolutely. So we're happy, we're seeking high dividend paying stocks in Canada on the TSX. And so, of course, we're going to screen for high dividend yielders. There's going to be a minimum market cap. We don't want any junior, really, really small companies. But the big thing we're looking for is a dividend payout ratio. So that means how much of a company's cash are they paying out as dividends, right? So if you're paying out over 100% of your earnings as dividends, you can't do that for very long. So we're screening for the payout ratio. Dividend coverage, what that means is how much of the
Cash flow.
dividend is covered by the cash flow or the earnings of the firm as well. So we want to see a coverage over a certain amount, and then the growth rate of the dividend over 3-5 years, different things like that, just to make sure that we're picking companies that have high dividends, sustainable dividends. So they're not just high currently because they have to maintain their dividend, but they can't do that for very long, and that they're going to be paying that dividend consistently going forward.
And maybe even growing it. So what if you were to put together this portfolio right now, what we've talked about, how many stocks and what's the yield?
We're looking at putting 20 stocks in this portfolio. We're going to be well diversified. We'll have some limits around sector to make sure we're representing the entire Canadian market, excuse me. And the yield we're seeing based on what we're currently running is around 6%, maybe a little bit higher. And we're really, really happy with that yield because we have to remember dividends are taxed more favorably than income in Canada and most places. And so 6% is much higher than 6% on an interest earning investment or a bond or GIC, something like that, right?
So using just an envelope, you quickly look at it, you'd say that approximately, the exact math would be a little bit different than this, but approximately a 6% dividend yield would be equivalent to what type of bond yield?
Probably around 8%. Yeah.
Probably around 8%. Yeah.
Yeah. So what we look, if you're at the highest tax bracket in Alberta, it's around 50% for income, but only 34% for dividends at the same tax bracket, right? So there's substantial savings there. And so, that results in, a 6%
There is
dividend.
really good logic. The government has really good logic in why they tax dividends at a lower rate than bonds. It's not because it's higher risk. The fact is, it's because the company has already paid corporate taxes on it.
Yes.
And so to tax it as if it's interest income would be saying it was double taxation anyway, but it's not as onerous. So that's the reason, is that the company has already paid taxes. It's after-tax money that's paid. The question that I want to ask now is what's the timeline on getting this in place? When could people put money into this strategy?
Well, if you're interested in the strategy, we understand it's a new strategy. Mark's going to have it in his account. We have every strategy we offer in mine or Mark's account. Let me know. We'll obviously be reaching out to clients we feel like this may be applicable to, or at least I will. Now, in terms of when, honestly, it won't take more than a few weeks, I believe, to get this set up. We're very close. We've been working on it for some time. So if you feel comfortable or interested, we can definitely put that.
So we might be able to do something September 1. The other thing is we'll be rebalancing these. Right now, we're thinking of an annual anniversary rebalance on each account. So every account will have its own anniversary date or anniversary month. And in the month of that anniversary, we will rebalance each account back into the equal weighting of 20 stocks. Okay, absolutely. I think we're done.
I think so.
Thank you. Thank you for your time, Tarek. Wrap it up.
All right. Thank you for tuning in. Appreciate it. If you have any questions, concerns, or if you want to talk about your own investments, always reach out to us. Thanks.